All right, everybody. This week, I want to go over the best performing Canadian stock inside of my portfolio, and that is Well Health Technologies. So this was a company that has done very well for me over the last year. It had a bit of headwinds and a bit of negative sentiment coming out of the pandemic because a lot of people thought of this company as a pure play digital health provider that, exploded during the pandemic. I mean, when we look to the price returns since its IPO, we can see that it ran up a ton in 2021, 2020. Obviously we're in full-blown lockdown mode during that period. The company realized a ton of growth that was pulled in, I would say, from future years just because of this type of situation. But during the sell-off, I believe a lot of investors didn't really realize that this company is not just solely a digital health provider. It is a very acquisition-heavy company that not only provides digital healthcare, but it also provides physical locations as well. And at a market cap of $1.7 billion, it is still very much a small cap stock, but it does have, a pretty big market share on the industry it operates in. So in this video, I'm going to go over the company's recent quarter, the company's current valuations, things like that. And I'm going to, kind of give an idea as to whether or not I'm still adding the company, despite being up quite a bit on my current shares. I mean, the stock is up 76% overall this year, but I'm up much more than that on my total position. So everybody, as always, 3 stock picks in the description. You can grab them for free directly from our premium platform. There are 3 stocks that I really like heading into 2025. So you can grab that report for free, and remember to like and subscribe to the channel for more great content. So let's dig right into it. Well Health. So what exactly does Well Health do? They operate a large network of healthcare clinics across Canada, but due to, heavy acquisitions over the last few years, they also operate in the United States. So they not only have a physical clinic network, they have a ton of virtual care services. So they offer telehealth consultations, and they, focus on, enhancing accessibility for those who, may not be able to get to a physical clinic because they live in an underserved area or somewhere remotely, or they just aren't able to. They also offer a lot of specialized care, cardiology, dermatology, mental health, physiotherapy, things like that. Their digital health platforms, they offer electronic medical records. So they help practitioners by, they pretty much streamline patient management. They provide a SaaS-based electronic medical record system, so that generates recurring revenue. They then have their telehealth system. They then have their billing and practice management, which effectively it's software for healthcare providers to manage the billing, the scheduling, the operations efficiently. And then they have, AI and data analytics, which invests in tools that, they provide data-driven insights for practitioners to essentially improve patient care. So overall, the company's recent quarter was one that was very, very strong. I mean, we're looking at Q3 revenue. It's up year over year, 23%. We look at adjusted EBITDA, up 16%. It's actually up 6% quarter over quarter, which is very good. But the one thing that has always been a knock on Well Health has kind of been its profitability. It had been acquisition heavy in a time where, acquisitions were not really being taken that well. I mean, think 2022, 2023. When we look back to the COVID-19 pandemic, acquisitions were so crazy. The market was very bullish. Pretty much any company you acquired caused the company to launch in price. But in 2022 and 2023, this was actually kind of reversed, and people didn't like this type of spending. They really, wanted to focus on profitability. But when we look to the Q3 free cash flow available to shareholders, we're looking at a 70%, 69% increase on a year-over-year basis, and an 85% increase on a quarter-over-quarter basis. And that, I do believe, is what is launching the company right now. It is that overall growth in profitability and free cash flow. We're looking at organic revenue growth of 22% in Canada and 25% in the United States, which shows that this company can grow organically. It doesn't just need to be acquisitions. When we look to net debt, like essentially debt ratios, they're reducing as well. When we look to the last quarter, this wouldn't be year over year. This would be the second quarter of 2024, 2.67x, and now we're looking at 2.5x. So they're reducing their leverage ratios pretty effectively on a quarter-over-quarter basis, and free cash flow per share, 6.5 cents. That's up 62% and 83% year over year. So when we look to the company's overall KPIs, we're looking at 4,000 plus providers in the network. We're looking at a 41% year over year increase in care interactions, 35% of that being organic. So 1.5 million patient visits, 41% year over year, 31% organic. And we're looking at Canadian patient visit growth, 46%, 26% of that being organic. And then year over year, US patient visits, 35%, which is all organic growth. So as a result, the company ended up updating its 2024 annual guidance, which effectively comes in higher than they expected. We're looking at revenue of $985 to $995 million. And when we look to the company's overall revenue in 2023, we're looking at $776 million. So this is some pretty notable year-over-year growth. And the crazy thing is, if we go back to 2018, this company earned $10 million. COVID-19 was a huge boost to the business. I mean, 2020 to 2021, you're talking about a 6x growth just in revenue. And now even from 2021 to 2023, we're, more than a double. And now we're sitting at, we're probably going to approach $1 billion in revenue in 2024. So adjusted EBITDA is going to come in at the upper half. So we're probably looking at $130 million in adjusted EBITDA, and free cash flow available to shareholders, $55 million. So that's a pretty big boost, and profitability was a big concern for this company, and they're just continuing to grow on that front. We look at their Canadian clinics revenue growth, 2021 to 2024, 47% compound annual growth rate, adjusted EBITDA 42%, and we look to total clinics, 128 back in 2022 to 185 today. So again, they're just continuing to grow. We're looking at double-digit returns on invested capital on pretty much every segment of the Canadian business. And when we come down and look to the two major US acquisitions they made over the years that, again, were kind of not very well received when they happened, but are now providing very strong growth. So what Wisp does, it's a US based company but they focus on reproductive sexual health, things like that. So treatments for, STIs, birth control, emergency contraception, things like that. So this is growing at a 35% year over year basis. Circle Medical would be, it's effectively, a mental health and primary care service in the United States. So, I mean, they focus on acute illnesses, preventative care, things like that. 61% revenue growth. This is a fourth consecutive quarter of adjusted EBITDA profitability. And overall, I mean, these acquisitions are proving to be very strong for Well Health right now. And another thing I'd actually like to focus on is the share dilution. So, Well Health, obviously, with them being a small cap stock, primarily fueled for growth, I mean, a lot of their compensation will be share-based. And when we look to 2021, 2022, and 2023, it's relatively high, but they are really reducing this moving forward. They're mostly working on a cash-based compensation, which ultimately dilutes shareholders less. I mean, when we go to a total share count for Well Health, we can see a lot of dilution in the pandemic and leading forward to the pandemic, but this has really slowed down as of late. Now, the one thing is, share dilution isn't exactly a bad thing when we look to share price. I mean, most of the dilution the company was offering was when share prices were very high here. It is not necessarily a bad idea for a company to issue equity when share prices are high. This is actually, can somewhat be seen as a good thing. They're reducing that share-based compensation, which is ultimately something you want to see and is ultimately a result of the company becoming more profitable. So when we look to overall share dilution, we're looking again 10.2% in 2022, 4.4% in 2023, and they're coming down to around 3.4% in 2024. So this is a good sign. I mean, obviously they're acquiring less moving forward. Share prices are lower, so they're obviously not going to issue as much equity. It's not as advantageous. And obviously, again, as they become more profitable, they're going to be able to issue more cash compensation. If we look to their normal course issue bid, they have actually bought back shares if we look from June to September. So obviously, this is a very, very tiny amount of shares, but they bought back around 294,000 shares at an average price of, $4 a share, and we're looking at $7 right now. So overall, the company looks to be doing everything right, from transitioning from a high growth, unprofitable company to a profitable, high growing company yet again. And they've done that through very strategic acquisitions and just growing their market share in Canada. When we look at the overall growth of the company, I mean, we're looking at, if we look to their actual free cash flow numbers, we can see that they're growing significantly. I mean, we're talking about during the lows in 2023, 58 million in free cash flow, and now we're jumping up to 114 million over the trailing 12 months. And as a result, this actually provided, I'm looking to free cash flow yield here, and for a couple of years, you could have bought this company at a 6 or 7% free cash flow yield. And at one point, it jumped up to 10.62. I generally consider any sort of free cash flow yield above 7% to be very, very strong value. I mean, and right now, we're sitting at 6.63%. So ultimately, you're still getting, this is obviously only one metric, but you're still getting a very strong free cash flow yield on your purchases today, despite the company being up, 78% year over year. And when we look to valuations at this point, the company is not all that expensive. I mean, we're looking at 25x trailing earnings, 23x forward earnings, but we're looking at only 15x trailing free cash flows. Now, there's really the company hasn't really been trading all that long, so all we have is 3-year median averages, which shows, a slight premium. But the only thing is, this 3-year median average would have the big 2021, 2022, 2023 drawdown in the company's share price. So I do believe that this multiple, even though it's trading at a premium, is probably, a bit on the low end. And it's kind of crazy to see. We've seen Well Health, which for a very long time traded at a discount to a big company like Teladoc. We're actually seeing it trade at a premium right now. We're looking at Well Health 15x free cash flow, whereas Teladoc trades at 8.7x. And when we look to TDoc from a pricing perspective, it just has not performed that well relative to Well Health over the last while. I mean, we're looking at essentially a complete and utter collapse in TDoc's share price. We're looking at $300 down to $10 a share. The company is just not as profitable. I mean, we're looking at negative operating margins. We're looking at, debt to equity, much higher debt to equity, much higher debt levels. And just overall, it just has not been that good of a company. And this was a company that Well Health was kind of compared to for a very long time, but it's an entirely different company. It is a much higher quality company. And just overall, I'm still pretty bullish on the company moving forward. When we look to analyst estimates, they're fairly bullish as well. I mean, we look to, expected earnings of around 24.3 cents per share in 2024. We're looking to, that's supposed to grow to around 30 cents per share in 2025 and then 39 cents per share in 2026. Obviously, very hard to predict, but this level of earnings growth, I believe, especially if they continue to be profitable, continue to increase margins, continue to fuel free cash flow growth, tone down that share dilution, this is a pretty appropriate valuation. I would say it was a small cap stock that I believe provided a lot of opportunity over the last few years. This is a company we've covered over at Stocktrades Premium. We first highlighted it in 2020. And I guess the final thing that I'll go over is those debt levels. I was showing you TDoc. I mean, they had a relatively poor debt to equity, relatively low interest coverage ratios. I mean, we look at Well Health. They have around 320 million in debt, around 115 million in free cash flow generation. And when we come down, we looked at debt to equity of 0.37. So this is a fairly strong debt to equity ratio, especially for a high growing company. And we looked at interest coverage ratios of 3.66x. It's a fairly comfortable interest coverage ratio. Would I like to see it higher? Yes, but ultimately this isn't the end of the world for me. I mean, overall, I'm still bullish on the company. I still plan to add shares just like I did over the last 3 years. I've held this company for quite some time and it's starting to pay off right now. The company should be able to grow at a double-digit pace if it can keep growing that free cash flow, revenue, things like that, organically especially. I mean, we're starting to see positive returns on invested capital. We're starting to see positive returns on equity. Just overall, I'm still pretty bullish. It's a relatively small position for me because it is, a small cap growth stock. I believe it's around 2% of my total portfolio, but I'm still pretty bullish moving forward. Let me know if you own Well Health. Let me know how long you've owned it for, and let me know what your best performing stock is in the comments down below on the year. I definitely want to hear from you. And as always, there is a free report on 3 stocks I really love from our premium platform heading into 2025. And as always, like the video, subscribe to the channel, and stay tuned for more great investing content.